Good afternoon, everyone. I'm Dave Burrows, President Chief Investment Strategist at Barometer. We have a lot of friends on the line today, and so I want to thank everybody for tuning in. We are here toward the end of January and now in a new year, 2022. I think many people know kind of our views as to where things are going, but this call is a little bit retrospective. We're going to look back on 2021, the things that worked, the things that didn't. One of the reasons I wanted to do this call is because we do wind up having lots of conversations around this time of year. Everybody follows the news. Everybody looks backward to see, how they think they've done. It's amazing how many phone calls we have to discuss a variance between what people had as returns in their portfolios versus the S&P 500. And I guess off the top, I just want to comment that I don't think we have one client who has given us a mandate to have a portfolio invested in the S&P 500 or anything like it. For the most part, people are asking us to run balanced portfolios, a combination of income securities, fixed income, equities, in some cases, opportunity to use commodities as a complement. And the goal here is to try to generate a return with a risk characteristic that people can live with. So we're always looking for return, but a big part of this is how much risk do we take to get it? And over time, we pretty careful to say we are going to act very unlike the index. In some cases, that's a really great thing. In some cases, we'd love to have an index return like the S&P 500. But what I thought I'd do today is talk a little bit about the various pools that we manage, and we can talk about them sort of as a composite as to what people's portfolios look like, what worked in each of the pools, and what things didn't. Now, every pool is a different mandate. And the reason we have them is because they will all act differently at different points in time. The second thing I wanted to say is that realistically, the market follows its own timetable. So there are themes that lift for a period of time and then rest and recharge and then go again. The market works in its own timetable, its market time. And sometimes market time can feel a lot longer than people time because we have people who check their portfolios, frankly, every day, which is far too often. There's studies that have shown that people who check their portfolios daily or even weekly wind up with lower returns than other people because they do get impatient. So this is kind of a process to go through to ask the question, are the various pools doing what they should do over time to provide the kind of return characteristics that I think our clients are looking for? So I've asked Brian McNichol and James Callahan to join the call today. Two of our young equity analysts are going to talk a little bit about some of the things that worked and what didn't work. But I just want to start off the top by just putting this up because I put this up on virtually every weekly webcast. And it's something I feel really strongly about. In a bear market, the most important skill is to be a good seller. So recognizing a shift from a strong environment to a weak environment is a really important one. Something, frankly, that I'm proud of in 2008, 2020 in the COVID sell-off. We recognized an issue early and gave up less than half of the decline in the market through that period. But the second piece is harder. In a bull market, the hardest thing to do is to stay with your winners. And you're going to have periods of time where your leading groups run like crazy and it feels great. And then they're going to get a little ahead of themselves and they're going to have a rest. And a rest might be 3, 4, 5 months. And in the meantime, maybe the things that have underperformed will catch a bit of a bid. Public opinion will shift a little bit. People will go back to what has been working until it becomes clear again that actually that's over and the new leadership continues on. And it's very easy to get shaken out of your winning positions because there are wobbles in bull markets. And along the way, it's hard to sit through some of those. So let's just talk just from the top quickly, as we always do. We believe we're in a bull market for stocks. And the US stock market led the way off the bottom in 2013 and has been working its higher since but with some significant fits and starts, as we all have learned. And you have to try and manage your way through that. But most importantly, in a structural bull market like the 80s and 90s or the 50s and 60s, you want to try and stay long that asset class, even though there are some wobbles. When we look at rates, I think most of you know, we believe we've gone from an environment of falling interest rates, which went on from 1981, starting at 15.8% on a 10-year bond, all the way down pretty much to zero at the COVID bottom. And the last time we went through a bottoming period, it took about 5 years to go through that process. I think we were in that process in 2016, 17, when we got that last shot down in the COVID scare. But the fact is, that's a process that takes place. And I think that most people know that we've had a view that, inflation is an issue. We know at the end of the Second World War, there were 2 years of significant inflation as demand came back and the baby boom started. But then inflation waned and waxed for a few years until ultimately you wound up in a sustained inflationary environment. And our view has been that we had entered a reflationary environment when rates started to work their way higher, as they did in 2020. But even in a reflationary environment, you're going to get short interest rate cycles with the business cycle. So this is Fed funds from the early 1950s to 1958 worked their way higher from 0.5% to 2.5%. It wasn't from 1.5% to 8. It was 1.5 to 2.5. Then right back down to 0.5% again in the late 50s, then to 4%, and over that business cycle eventually retraced down to 2%. This is kind of the environment that we think we are in. A reflation of assets. There are going to be inflationary spikes where people get concerned, but it's probably not going to be all that sustainable over many years. We're going to get ups and downs. So this is the 10-year bond. And this is we're looking at yields. So we know that from February of this past year, through until March, we had a big move higher in yields. And in fact, yields started to move higher in March of 2020 from 0.5% and worked their way very quickly to the spring of this year to 1.7%. A very significant move. And then what happened? Well, they took a rest, and yields from April through the fall just consolidated. But I think we know that at the end of the year, they started to spike again, of course, through year end, have continued on and started a new leg higher. So reflation started in March of 2020, ran like crazy into the spring, April, May of this year. And then that reflation or inflation trade took a rest. We know it happened all the way around the world. German yields have done the same thing. But the message is clear. We've started a bond bear market. This is the aggregate bond index from August of 2020 through the beginning of 2021, the period that we're talking about, sold off sharply into the spring, then rested, but now has continued. And we're into the next leg down in bond prices and probably the next leg up in reflationary assets. But through the course of the year, I think our message is very clear, very concerned about fixed income, concerned about interest rates. We need to have portfolios that can do well during rising rates or falling bond prices. In fact, 2021 was the first year in 30 years where bonds gave a negative return. And I'm pleased to say that we had pretty close to no bonds in the portfolios other than the ones we had to have in the balanced portfolio. If we take the 30-year, 20 to 30-year bond, you can see that over the course of the past year, fell about 13%. So this is a big issue because for bond and for many investors, fixed income has always been a sort of a shock absorber. So we have to find other ways to get shock absorption and have to find other ways to get yield because this one is not working. It's one that we avoided through the year, and I think the one that we will continue to avoid. We talked a little bit about commodity prices over the last year with a view that in the early 1930s, you got to a point where the 10-year rolling return on commodity prices was minus 10%. And when the rolling returns started to turn positive, it went on for a decade. And similarly, when it happened in the 1950s, when they turned positive, it went on for the next 20 years until ultimately you had 18% annualized positive returns, a structural shift. And we believed last year we were going through a secular bottoming again in yield in commodity prices. And once again, we traded up through the zero line on the 10-year returns. But that's the beginning of something, not the end. And when we look at, for instance, the Rogers Commodities Index through 2020, starting in about November and straight through until the spring of 2021, they worked their way higher, and then we rested a little bit over a 4 or 5 month period, but resolved higher. Now, at the beginning of last year, we talked about the impact of all of the dollars that had been printed in 2020. And that dollar printing continued through 2021. And that was a concern to us as to how that might impact portfolios that in the old world were structured for falling interest rates or disinflation. We know that commodity prices this past year rallied sharply, first from November into the spring, and then sideways through the summer, but in September, October began the next leg higher. And here we are basically at new highs in commodity prices. That's important because that's something that works during rising rates or during an inflationary period. Let's talk about the S&P 500, the US stock index. Now, the US stock index, the S&P 500, is dominated about 40% with 5 or 6 really big companies. And so they certainly were great performers coming out of COVID. And from November through August, again, very strong. Then we had a consolidation period. But during that period, the NASDAQ performed particularly well. But the NASDAQ, again, is dominated by 5 or 6 stocks, and unlikely that we would have 7 or 8 or 10% in one company like an Amazon or an Apple. We're going to have them, but we're not going to have giant size. Now, over the last year, it became consensus inflation was an issue. From the National Institute of Small Business, biggest concern that they had was inflation. On inflation expectations, the 1 year ahead expectations sort of rocketed through the course of the year. And we know that commodity prices went along with it. And so that's something that we anticipated early in the year and made a part of our portfolios. In the last few months, the Fed has become significantly more hawkish. They went from a view that inflation was transitory to take that language out. It doesn't mean that they don't believe it's transitory, but they don't want to hitch their wagon to that. And in the meantime said, we're going to start a Fed rate hiking cycle. And these are 2-year yields from October through end of the year, which clearly worked their way a lot higher, from 20 basis points in September to 75 basis points. And the expectation was at year end, we might have 3 or even 4 rate hikes over the course of the year. And of course, that started to put pressure on anything that gets hurt by high interest rates. So like what? Well, the NASDAQ started sensing this early. This is the percent of NASDAQ stocks trading above their 200-day moving average. And that started to fall dramatically, the number of stocks trading above long-term trend. However, the leading stocks, the big 5 or 6, Apple, Amazon, Google, Netflix, and so on, remained very strong right up until December. But if you take the high growth part of the tech market, this is Cathie Wood's ARK Innovation ETF. It actually peaked in February, went sideways through the summer, and then started to sell off into the end of year, and then frankly has continued weaker since then, closing at new lows today. So that requires recognizing change. If we look at our portfolios, the various pools had various amounts of success. The balanced portfolio F class, which is what we use with clients, was up about 18%. The income portfolio is up about 11.4. That's great. Macro was up 22. That's great. But this has been raised to us, the 1-year returns from equity and long short. So I want to start with that because that was our most tricky, those were our most tricky pools over the course of the year. They're there to own equities. If we're going to own tech, realistically, that's where we're going to own them. They're growth portfolios. And while it certainly hurt us in the year, if we were to look at it over longer periods, we're going to see the numbers a little bit different. But let's just start off the top. We'll go one by one. Let's start with balanced. If we look at the balanced portfolio, this is the balanced portfolio through the course of 2020, December 31st, 2020, December 31st, 2021. The annual equivalent return was 17.85%. So let's talk about this portfolio. It's partly equities and partly fixed income. It has to have at least 25% fixed income because it's a balanced portfolio. Thankfully, Jim Skatakis did a masterful job in managing the 25% that we had to own. No long-term bonds. He kept it short-term, about 3 years in duration. He focused in corporate bonds, which means if you can find the right corporate issuer of bonds and their lot in life is improving, they can outperform government bonds because their credit risk is getting better. And I'm proud to say that for Jim, he executed that part of the portfolio brilliantly. And actually, in a year where the bond market was broadly negative, had just about a plus 2% return on the bond portfolio. The equity portion of the portfolio is a more conservative basket of equities. This is meant to be a lower volatility portfolio. And the risk reward over the course of the year, I think, was brilliant considering he had to lug fixed income component. If we look at it, though, from the beginning of the reflationary trade, the reflationary theme lifted off at the end of October, just before the election in 2020. And over the course of that, whatever it is, 13 months, had a 24% annual equivalent return. So when we go back and talk about the market time versus people time, we all like to look at things in a calendar perspective, but we have to look at things in market cycles. And we know that this portfolio did really, really well in that first leg of reflation. And yeah, there was a rest along the way, but then ultimately as the next leg of reflation got going again, started to lift a second time. And so the annualized return over the period from the beginning of the reflation trade is 24%. If we take the income portfolio, the income portfolio, if you'll remember, is a portfolio of income producing assets. We use it instead of using a lot of fixed income. It can hold fixed income, government debt, corporate bonds, preferred shares. It can own real estate investment trusts. Anything that generates an income, and it's left up to us to be tactical with the portfolio to try and find the places that will generate us return. In rising rates, the hardest thing to do is to generate an income tactical return. And I'm really proud of the guys, and Greg in particular, for focusing this portfolio in dividend growth-oriented securities, not fixed income, not preferreds, not high dividend paying stocks, but in dividend growth-oriented securities. And over the course of the year, generated an 11.5% return. So I think that's dynamite in a year where fixed income was negative. If we take from the beginning of the reflationary trade, so the end of October, beginning of April 2020, about 13 months, it's 20.5% annualized equivalent, or total return of 24%. Again, I couldn't ask for anything more from an income portfolio. So balanced in income, great job, guys. Let's talk about equities. And this was the problem in 2021. Very clearly, if we take 2021, it was a difficult year here. And we're going to talk a little bit about what was difficult. But I don't want you to forget what happened in 2020 in these two portfolios. Again, we're talking market time, not people time. The 2-year return for the long short fund was 43%. The 2-year return for the equity portfolio is 36. You annualize those numbers over 2 years, 16.6% and 20.2, versus a blended relevant benchmark, which is 70% the all world stock index and 30% the TSX S&P 60, which comes in at a 16.7% 2-year annualized return. So long short looks pretty good. Equity looks pretty much bang in line, but clearly 2021 was difficult. So maybe, James, sorry to put you on the hot spot, maybe you could talk a little bit about what happened in this portfolio. And I'm going to start with this picture of high growth tech that started to underperform in February and March, a theme that really had been the theme for several years leading up to 2021.
Yeah, absolutely. I can. Thanks, Dave. So I think the focus should be on technology. And, to think about the technology space last year, and especially in Q4, the space as a whole, you can slice it up a million ways, whether it be into industries or sub-industries, by profitability or revenue growth, whatever you choose to use. I think in this case, the most helpful way to bucket technology is into 2 buckets. And the first would be the profitable tech. And those companies may have slower growth. They're generally more mature. So companies like Apple, Microsoft, Broadcom, for example, ones that we own. And they sometimes pay substantial growing dividends and are more suitable for inclusion into our income-oriented portfolios. And then the second bucket would be low or no profitability tech, which are typically smaller, faster growing companies that are spending to maintain or accelerate revenue growth. And these are names we're more inclined to include in our equity and long short products. So I know on these calls before, Dave, you've spoken at length about long duration versus shorter duration assets. And the second basket, the unprofitable tech basket, definitely skews longer in duration.
Maybe you could explain, James, just quickly the idea, what it means, long duration.
Yeah, so I mean, when we're talking about duration in this context, it's really a term that we're borrowing from bond analysis. And when you're looking at a bond, duration measures the bond's sensitivity to interest rate changes. So a bond with higher duration is more sensitive to interest rate moves.
Right. So if you buy a company where the earnings are off in the future, the further off the substantial earnings there are, and when rates start to move higher and you discount those earnings back to the present, it means that the company is worth less if you have a higher discount rate or interest rate in the economy.
Yeah, that's exactly right. And what we've seen over time is that, during periods of rising interest rates, investors, generally rotate into companies that are producing cash today, because on a relative basis, they become more valuable versus companies that are, may produce cash 10 years from now.
Right. So we got impacted early on in some of those higher growth companies, the ones that had been, really rocketing in 2020, gave us great returns in 2020, and long short, whatever, was 40 some odd percent. That started in the spring. Maybe you could just talk through a couple of examples of things that, were working up to that point, but certainly stopped.
Yeah, absolutely. So the first one I think would be SciTime. So I've talked about SciTime on these calls before. We sold SciTime on December 13th after a failed rally attempt. It was a technical decision and based on what we think is a thematic shift away from unprofitable tech. We love the company. I love the company, but we thought last month that the time to love the stock was probably finished for a while. As you mentioned, Dave, these themes can a lot of the times in bull markets take 4 or 5 month pauses. So we moved on then, and that was the right call. It's sold off substantially since then. And then the second name would be Unity. So we sold Unity on December 2nd after a large one-day decline followed what could have been only a short pullback. Again, there's nothing wrong at all with the fundamentals. Unity is going to remain one of the best ways to play the metaverse trend, but it trades at a very high multiple. So it was no longer the time to own it, and we moved on then.
It's amazing. Something like 70% of the companies in the NASDAQ are down 30% or more. And I think the number of companies that are down 50 to 70% is something in the 60 to 65% range. So really, technology, I mean, if we're going to own it, it's going to be in our equity portfolio. It's what is technology as a percent of the S&P?
It's about 27%.
Yeah, and it was probably 34, 35 in November. We talked through the course of the year about the fact that we've been scaling back technology as a percent of our holdings. And certainly today it's a much, much smaller piece because we've been stopped out of a lot of positions. But thankfully, the equity portfolio is one portfolio, which in certain years has been fantastic. Last year was not so good. The other thing that really impacted us over the course of the year was our selling strategy, which has saved us from pain in a lot of cases. But in the case of energy, I think really caused us some difficulty. And maybe, Brian, you could talk a little bit about that.
Yeah, of course. So we were definitely positioned pretty well in the sector heading into the summer for a move higher in the overall price of oil. Just with the global economy set to reopen aggressively, we definitely saw the overall demand rising and supply in the market was extremely tight. However, during roughly July, we were stopped out of the sector. And this was largely driven by a demand deterioration sell-off in the underlying commodities. So this was due to a new spike of COVID during the summer when the Delta variant was running rampant. So even though the energy market supply was so tight, the notion that the diminishing demand was going to evaporate and overall just derail the reflation and reopening theme within the energy sector. So during this period, we started seeing both crude oil and natural gas spot pricing fall off, and we saw broad-based selling across the sector, regardless of the fundamentals for the companies. So for us, that triggered stop losses, and we exited the positions and brought our overall exposure in the sector down.
Now, of course, here's two stories, right? The technology story is one that started breaking down and then has just continued. And thankfully, we have very little exposure. In the case of energy, something we thought was the beginning of a new structural theme certainly sold off 24% actually in the course of July and August, which, as you know, in the underlying stocks, probably a little bit more. There's only so much we can take. Sadly, in this case, the group turned around and took off through September, October, and through into year end and as it sits now. Now, as it sits, Brian, what is our weight in energy in the equity portfolio?
Within the equity portfolio right now, it is, apologies, got that number right in front of me. Equities, it is roughly 18%.
Okay. So this is a story where we did get stopped on the position, but through the course of early fall, we built the positions and actually are in a spot where today in strong energy, we have a strong position both in natural gas producers and in the crude oil producers, both in the US and in Canada. And very clearly it is leadership in the market, but certainly that cost us some portfolio performance over the course of the summer. And so the combination of technology and the sell-off in energy, when we went back and did the rehash on what worked and what didn't, were the two big factors. As we sit today, energy continues to strengthen. We've got a significant weight, and technology continues to weaken. We have a very low weight. You got to recognize change and be able to be there for the next big leg as it comes. And I think that's sort of the case. So that's maybe enough just to rehash on equity. We can certainly come back and answer questions on it later. But the net of it is that the equity portfolio, if we went from the COVID bottom, March of 2020 through year end, the annualized return in the equity portfolio was 30% a year. So I'm not happy with the annual or the calendar year 2021, but I am happy with a 60% return off the bottom to the end of December. Okay, so what do we look forward to? Well, this was the rally in reflation assets from November until spring. certainly reflation or value went sideways from May until December, and then started to lift off to start a new leg. So our view is that reflationary theme that we are invested for, while it tested people's patience through the summer and fall, very clearly has started the next leg higher. So let's take all of these things and put them together and talk about the macro portfolio, because the macro portfolio is a multi-asset portfolio aimed at generating a return, not like a stock index, not like the bond index. It's to give an overall mix of assets, long and short. It can be in equities, either domestic or emerging market. It can be in commodity prices. It can be in bonds, long or short. It could be in real estate. It can be in really any type of tradable asset. So over the course of the year, that was a 22% return. I'm proud of that. This is something that I spend a lot of time focused on. From the beginning of the reflationary lift, October 30th of 2020 through year end, up 52%, or an annualized equivalent of 43. And again, as we talk about, we went through a period of rest in the reflationary theme, and that has reignited since then. So we'll talk a little bit about some of the leadership themes, but this poses a rover in the portfolio. We've got income in the high income. We've got conservative equity balanced mix in the balanced portfolio. The equity portfolio is a little bit more octane at times and long short. And then the macro portfolio is a go anywhere portfolio, long or short, that's meant to be a diversifier. And it certainly did its job over the last couple of years. So let's talk about leadership as we come out of 2021 into 2022. Where do things look? Where are things going? As you know, our job is to make sure we're focused in areas that are relevant. We have to recognize change and make changes in the portfolio, like shifting away from technology. And then we have to be prepared to play defense where it's necessary. So where are we not? We are not focused in fixed income. Fixed income continues to weaken. As of today, the aggregate bond index is making a new low. We're not focused in high dividend paying stocks. So in the income portfolio, it's not high dividend, it's not fixed income, it's not corporate bonds, it's not preferred shares. We're focused in dividend growth securities. And this is an ETF, which is a proxy on dividend growth oriented securities. Dividends have always been an important part of a portfolio returns in the market. And if you can get dividend growth during a period of rising interest rates, it's attractive, which is why it's outperforming the market as a whole. If we look at the equity portfolios, we're not focused in high growth tech. It's been a great place over the last many years. It's not a great place today. I don't know when it will be again. Is it cheap? Not really. The difference between where a momentum investor stops buying and where a value investor steps in can be significant. You can see this portfolio, Kathy Wood's high growth tech ETF, is down 52% off the highs since February. Where it stops, we don't know. We're not focused on software. Software sector is down 22% from the highs in November. We're not based in cloud computing, 22.6% decline since the early part of December. We are focused in financials, our biggest weight by far, and this is the ZEB equally weighted Canadian Bank Index. Obviously a strong performer, and very importantly, when we look at the bank sector in the US as a whole, it only just recently made new highs since 2008. It did pull back over 1, 2, 3, 4, 5 months, but since fall has turned higher and is now making new highs. We're in a new leg of this bull market. When we think about basic materials, copper miners were in a bear market, well, since 2008, but consolidated from 2014 through 2021, broke out, had a rest through April, May, June, July, August, October, September, October, but now starting a new leg higher. When we look at commodities, it's the same picture for commodities as a whole. May through December, no real growth, but now starting another leg higher. as talk of reflation and inflation picked up. So this is obviously important both in our equity portfolios and in our macro portfolio. When we look at industrials, our industrials weights in aerospace and defense performing really, really well because we're seeing revisions higher in earnings estimates. In consumer staples, our consumer staples holdings, the retailers in grocery, have an ability generally to take price in an inflationary environment. The price of the goods go up. The psyche of the consumer is they expect higher prices, and it turns out that the food retailers take a little extra and become more profitable. When we talk about energy, we talked about the fact that in 2021, there were the fewest new barrels of oil found since 1946. 12.5 billion barrels in 2020, 4.7 billion in 2021. We know we're going to get to the other side of the Omicron variant. And so what are we seeing? We're seeing the energy index lift off as the market started to sense we get to the other side of Omicron. This is the Canadian Energy Index. So these groups are working. Energy relative to software, we know, is outperforming. And that's a change. So that's something that's important for us to recognize. And most importantly, value versus growth. The value ETF had its first great leg from November of 2020 through the spring, rested through the course of the summer, and very clearly started a new leg higher in December and into 2022. So high multiple stocks versus low multiple stocks, the differential is being squeezed now, but it's got a long way to go. So just to be clear, the leading groups, basic materials, industrials, energy, consumer discretionary, ex-Amazon, makes up 20% of the S&P 500. Those four groups are expected to grow their earnings in this quarter by 97.5% year over year. Revenue growth should be 23% revenue growth, and margins should expand by 70%. And in the last month, earnings estimates for those four sectors are up 9.5%. We take the rest of the S&P, which includes tech, healthcare, utilities, consumer staples, telecom, and actually financials. That 80% of the S&P is expected to grow its earnings by 8.7%, okay, versus 97.5. Revenue growth should be 10% versus 23% revenue growth for this cohort, which is 20% of the S&P, and 0% margin growth. So that's where the positive change is. That's where the structural tailwind is. When we look at the portfolios, our big weights, financials, more than double weight the market. Materials, well, you can see it's almost 6 times the market weight, which is where our weight is. Energy, 13%, just across the firm versus 3% for the S&P. Technology makes up 12% of our total weight, largely dividend paying cash flow generating companies versus 27% in the S&P. And the rest of the groups are not far off benchmark. The significant underweights would be communication services and healthcare. In the macro portfolio is exactly as we've talked about: financials, precious metals, commodities, energy, materials, industrials. These are reflationary assets, disinflationary assets. We're short fixed income, short global corporate bonds, short the US dollar, short mortgage-backed securities. So all of the portfolios have a different part to play. All of the portfolios in their own way are skewed toward a reflationary environment. The biggest risk in this economy is a reheating up of the economy as COVID comes to an end, which is why the Fed is looking at ratcheting rates higher. We need to own things that can do well in that environment. And I feel pretty confident coming into 2022 that the messaging through the course of the year has been on this theme, and the portfolios have morphed over the course of the year, again, to follow along these themes. We're now into earnings. The beginning of 2022, estimates continue to go higher for earnings. We know that the cases in the US and in Canada have been flattening and rolling over. I'm still concerned about the NASDAQ, which is why we're not there. when the market was really rallying, 90% of stocks were trading above their 200-day moving average. 93% of stocks were trading above their 200-day moving average here. At this point, 90% of companies are trading above their 200-day moving average, and then it started to deteriorate. And we're now actually down closer to only 40% of companies trading above their 200-day. Yet the flows into the growth stocks continue. People are buying the dip and can't accept the fact that maybe this could be a more challenged environment. So if the COVID cases can continue to roll over, I think that we have lots of opportunity in this reflationary theme. We will get defensive if it's required. Certainly by group, there are many groups we have been defensive in. And if the market was to continue to weaken, then we'll get more cautious. But we believe that just like we had a leg, the first leg of reflation from November to April of this past year, we think we've started the second leg, and I think more people are taking it seriously than they were a year ago. But it will take a long time for people to shift their views as to what has been working to what will be working going forward. So with that, if there are any questions, I'm certainly happy to answer them. Otherwise, if you'd like to shoot us a message or give us a call, we're happy to jump on the phone and answer any further questions. Every year is going to be a different year. I think this year is going to be an interesting one. There's bound to be things that we have to worry about that we're not considering now. But when I think about all of the issues and fears that investors have faced since the COVID low in March of 2020, it took a lot of process and diligence to make sure that we were invested through that period in assets that were relevant. And so from a risk reward standpoint, through the decline, I'm pleased that we gave up less than half. And since then, over the portfolios, they've all had their moment in the sun, but they all play their part. I don't see a single question. Okay, so with that, I'm going to end the call. Please don't hesitate to give us a call. We look forward to reviewing with you individually your own portfolio mix, things that you might want to change, things you might have questions about. But thank you very much for being clients. We treasure having all of your trust, and we look forward to working with you through the course of 2022. Thanks, Brian. Thanks, James. We'll look forward to having you on again. We'll do another quarterly call at the end of the March quarter, as we will for the rest of the year. Thanks so much. We look forward to seeing you on the Tuesday calls.